Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, this past Friday we had a better than expected jobs report, gaining more jobs. Manufacturing looked pretty good, but some of the manufacturing was helped from the fact that the GM strike ended, and that gave that sector a little bit of a boost. But in addition, the unemployment rate kicked down to 3.5%, which ties the lowest rate going back to 1969. So very low unemployment to say the least. The big news is going to be this coming week on the 15th, whether or not President Trump puts in the new tariffs or not. That's what the market's going to be watching for. It's probably going to be a little bit jittery moving into that. So let's take a look at the charts and see what they show. In the last recording, I talked about a couple scenarios that could play themselves out in the market as we head towards the end of the year. Two things that usually occur, and one usually outpaces the other one. The one scenario was the fact that we've had a lot of fund managers that have underperformed the market, and they're going to be chasing performance, trying to push the market higher so that they can get their numbers up, looking for bonuses, etc. And then the other scenario was the fact that a lot of people have been involved in the market. They've had a pretty decent year, and they may want to look to book those gains. So do they do it by the end of the year? Do they wait till after the first of the year and try to push things out and move the taxes into next year? That's always a consideration that they have to weigh out. And then we've got that wild card of December 15th with the potential new tariffs, and really getting an idea, because there's been some conflicting reports over the past week or so on whether or not we are going to see some sort of a phase one China trade deal. But here's something I wanted to show you on the chart. This is pretty interesting, where we talked about how even if we have an extension, usually we have a retracement area. So I wanted to show you what the Fib extension showed, and I added in a Fib level that I usually don't look at in the equities market. It's a pretty strong level for currencies if you're a currency trader, but usually doesn't hold as much weight in the equities market. Don't ask me why. It's just been my experience that it doesn't seem to be as much of a factor as strong as a support resistance level, and that's the 78.6% Fib level. But it is a Fibonacci level, and therefore it bears watching, especially when we have, look at this kind of a scenario. So I had mentioned in the last recording that if we're going to have an extension up to this 161.8% level, by Fibonacci rules, you normally will test the previous Fib level and then head to the more extended level. Well, the previous level that normally would occur is this previous stronger level of 61.8%. But you can't ignore the fact that we actually touched the 78.6% low on the 3rd of December there, and we've moved to the upside since. And now we're right back at those all-time highs. So we're sitting here looking at these all-time highs, but a couple concerns here are these gaps. Are we going to have to fill those gaps? Was that test of 78.6% enough? There's still some unanswered questions here, which is why we're maintaining the strangle for our subscribers on the S&P in case either one of these two scenarios plays out. At the time of this recording, the futures have dropped. Something occurred just a little while ago. The futures were up a few points. Now they're down about 11 handles. Still have a lot of time before the market opens, so things could rectify themselves. But I'd imagine there's some sort of a news event, probably with the U.S.-China trade deal or something that has come out, maybe having to do with the tariff, something that moved the market. It was a big spike to the downside. But again, 11 handles to the downside isn't that big of a deal. So just certainly was a piece of news. So I wanted to show you that. It's interesting because we don't talk about the 78.6% level very often. Let's look at the VIX, because the VIX did move up today. We were only down about just under 10 points in the market today. And so for that to cause the VIX to spike that high is quite interesting. But a move up in the VIX, it looks like the VIX is getting a little jittery, isn't it? I mean, we did have a pretty decent couple down days there with the 2nd and 3rd of December, and then it looked like, oh no, here we go with another December like last year. But then it caught itself and moved back to the upside. But giving this little elevation to the VIX is going to give some ammunition if the market does want to move to that extended Fib level. Now we have room because the VIX isn't hugging down against this strong area of support. Now we have areas where we can drop down. I also wanted to show you quickly here interest rates. they've held in that 61.8% level. You can see 63 on the low there, and that was the 3rd of December. So interesting that rates actually went up on the 2nd, but then when we had that gap down in the market, money did move into the bond market. That's why rates went down. Prices go up, yields and rates go down. That's what occurs when people are buying bonds or putting money into the bond market. So that didn't last very long, turned around and reversed, but we're just kind of in the sweet spot area here. Even a little bit higher to the upside isn't going to detour the market at all. And then looking at the dollar as well, same scenario. The dollar is also floundering in this wave 5 without any sort of a significant impulse in the move. So that's also giving room for the market to move to the upside if it wants to by the end of the year. But all bets could be off on December 15th. That's going to be a very important day, and we'll certainly be back to talk to you about what occurs on that day. So don't forget to give us a like, hit subscribe. Look forward to talking to you again soon. Take care, everybody.